What's up, YouTube? So today I'm actually going to play a clip for you guys. It was from Thursday, right? Apple had that huge bullish run, and someone questioned there was 80,000 contracts bought, 80,000 calls bought, spending 2.4 billion in Apple. So I want to explain, and I actually explained to the mentor group that night what it was, what he was doing, why he probably got calls instead of shares, and explain kind of like what people talk about when they talk about being synthetically long. So I'm going to play this clip for you guys, going over just that, because it's something I think a lot of people. It's something good to know. It's definitely something to have in your belt. Before we get into these tickers, if you're watching live, you guys have already know we're on a rant. Um, so we're reading the comments on my 6 minute, 5 minute, 57 seconds video on Apple, where I tell you tomorrow I'm going to look for a red candle to add on icing on the cake play. I tell you I'm bullish 13 times, maybe 14, depending on how technical you want to get. But I tell you I'm not short. I am long. I scaled out, still in it 13 times. So we got to read some of these awesome comments where they say, good luck on that short. And I'm trying to take advantage of people's emotions. Grammar and spelling were not a strong suit on that one. Good thing the stock market has about 3 colors in it. And then the last comments. Well, one of the first ones maybe. What do you think about today's huge option trade in Apple? Now, this is where I'm actually going to be serious. Someone bought 80,000 of the January 2021 calls, 150 strike price, for 2.4 billion. Now, each contract is valued at 100 shares. So take the math. He bought 80,000. Okay, times that by 100. Times that by $457. That's a whole lot more than 2.4 billion. So this is what I mean by synthetically long. You're bullish the company. You've given it plenty of time. January 2021. Tomorrow's red day, if there is a red day, the pullbacks, the ups and downs, not going to affect it that much. They'll be up and down, no more than it probably would. These are a 1-for-1 ratio. Deltas, they're rated at a per share basis. That far in the money, it's a 99, maybe even already a 1-to-1 ratio. So every dollar the stock moves, that option contract moves that same amount times 100. So instead of spending the capital on buying that many shares, they spent 2.4 billion and got so much more. Well, I guess, same amount for a whole lot less. That's when you hear the term synthetically long or short a position. They are basically buying those shares. In fact, let's pull that up actually. January. Synthetically blew my account. Wow, so that many calls would put a floor in anyway. No, guys, don't get confused. Options, they don't control the stock at all. Options, the contracts drive order flow, and they're their own entity, they're their own thing. You buy a lot of investors will buy calls and use shares to hedge their account. It used to be like, there are insurance products, you would buy shares and buy a put if you think it's going to go down. One of the ways you can do it, but they're so liquid now, they're so popular, you can actually vice versa, fix it or use your shares to hedge, if that makes sense. So you can spend $1 trillion on Apple calls, and it's not going to do anything to the ticker. Take 2.4 billion and buy the Apple shares, and you'll see an uptick. Take 2.4 and buy the calls, nothing. Yeah, they bought deep in the money. So they bought January 2021. The only expiration, it's January 15th, 2021. They bought, second. January 2021, they bought, where's this strike? Oh, let's get to Apple. What is this? Just assume it's on Apple. 1 second. January 15th. Strike 150 right here. So volume today. So 80,000 of that was traded today. Open interest, that's how many were kind of swung overnight. 80,000 of that was from one person. Now, where's the delta up here? Delta, 1-to-1 ratio. So if Apple goes up $1, so does that contract. He is already at the 1-to-1 ratio. That's a perfect example of a synthetic position. Instead of spending, he spent $2.4 billion and got how many shares versus how much would you have to spend in Apple and move the market? What would your fill be on something like that? It would be the crappiest fill ever. You would still be filling right now. Like, it would take forever to fill that. So, well, maybe not. Maybe Apple probably is liquid enough. But that's all he did. There's two ways to do this. Each contract $30K. Yep. Okay, so let's just do the math. Shorted. I know because I'm strolling now. He just commented. Okay, so he spent $2.4 billion. Man, how do we even do that on a calculator? 2.4 billion. He bought 80,000 contracts. So that's 8 million shares. Okay. Turn the phone sideways. Yeah. 8 million shares. 80,000 times 100. 8 million shares. 8 million shares times 457. That's a big number. That would cost you $3,656,000,000. But instead, they went the cheap route. They did the exact same thing and spent $2.4 billion. So what do I think about that? I think he's bullish. That's all. He bought a bunch of shares synthetically, long position, saved himself the capital. Yeah, they saved $1.2 billion, the cheap route. Have you guys ever Google this in your spare time? Google the picture, $1 million cash versus $1 billion cash. Because $1 million like fits in a briefcase, and then the billion fills up the room full of hundreds, like perfectly stacked. That puts that into perspective for you, just how much a billion is. So anyway, just wanted to talk about, if you ever hear somebody talk about synthetically long a position, they're doing just that. So we'll pull this up one more time. Let's see, January. Delta is rated per share basis, right? So every dollar it moves, this contract's going to move $1. This one right here, every dollar Apple moves, this contract's going to move 90 cents, but it's times 100, it's per share. So 1-to-1, your contract is going to expire at 1 or 0. It's the only option. And as you go down here cheaper, this is why you have to know what options actually are. You buy this one because it's the one you can afford. You bought some crap ticker that as Apple pushes up $1, this thing moves 11 cents. You're at the money, so always going to be right about 50 cents. This is your percentage of winning, percentage of it expiring in the money, which is why you're at the monies are always right there at that 50-50 mark. Because it's telling you 50% chance we go that way, 50% chance we go this way. 11% chance this actually pushes up and expires in the money. Also an 89% chance whoever sold you that contract is going to keep all your money. Don't start selling calls based off that, though, because in this market, volatility is too high. That's how you'll get wrecked. Volatility is back off and it's nothing. A lot of people will sell these contracts all day long. So I hope that was helping you out some. Does that clear things up for you guys? Let me know in the comments down below. Have you ever taken positions like this? Instead of buying a bunch of shares, you actually just bought contracts to go the cheaper route, to get the same effect. And then what do you guys think? You guys ready to drop 2.4 billion on Apple? While I am still pretty bullish, I don't know if my bank's that big yet. So let me know in the comments down below. Again, guys, if you're new to the channel, Don with the Don Franz Show. I know I'm saying this at the end. Welcome. Hopefully you do subscribe. I am doing a giveaway to the mentorship group, which that's a clip of what you saw. If I get to 10,000 subscribers for the end of August, right now at my current pace, I'm going to miss it by like 100. Yeah, like I'm gonna hit that the next day. So I need everyone's help to actually hit that. And I will see you guys in the next video.